Before the collapse, the crypto market was defined by extremes. Digital assets were generating massive wealth overnight, driven by high-speed volatility and an environment largely devoid of regulatory oversight. Retail money was flooding in, and institutional investors wanted exposure to the massive upside. But both groups hesitated. They were operating in a chaotic frontier, lacking the basic safeguards and infrastructure they relied on in traditional finance. This gap between ambition and security created an enormous opportunity. The market desperately wanted a grown-up in the room, a platform offering the dizzying speed of digital assets, but with the reliable mechanics of a traditional bank. By the time a solution appeared, people were no longer trying to buy a specific token or financial product. They were paying for the feeling of safety. FTX and its founder, Sam Bankman-Fried, arrived as the specific answer the anxious market was looking for. He did not look like a traditional Wall Street tycoon. Instead, he was packaged as something rarer, the awkward, brilliant outsider. A founder in a casual t-shirt and shorts, seemingly caring only about code and logic. In a space obsessed with disruption, investors read this unconventional aesthetic and his dense technical vocabulary as evidence of genius. That unchecked assumption gave the company permission to move at a breakneck pace, effectively skipping standard operational scrutiny. Modern finance often rewards the appearance of logic over the reality of it. In this environment, an unassuming image can serve as a highly effective shield against systemic scrutiny. The expansion was aggressive. Hundreds of millions of dollars arrived from major venture capital firms. Soon, the brand was plastered across sports arenas and backed by a relentless wave of high-profile celebrity endorsements. This rapid growth generated a massive reputational halo. As the valuation climbed, a dangerous logic took hold. If top-tier firms and famous faces were backing it, the underlying system must be sturdy. The momentum created a psychological trap. The larger the stage grew, the less anyone wanted to raise their hand and ask basic, boring questions about internal risk management. When a company is treated as a cultural inevitability, the burden of proving its financial health shifts away from the people running it and onto the public trusting it. We must map the two entities driving the empire, FTX, the neutral exchange, and Alameda, the risky trading firm. A strict barrier must protect customer deposits, but behind glass walls, that boundary vanished. Deposits were quietly siphoned to cover bets. This architecture is fatal. It means the catastrophic risk tearing the company apart was not an unpredictable external threat. It was a core pillar of the business model itself. The entire structure held until a single leaked document exposed the fragile balance sheet. Days later, a major competitor announced they were moving their assets off the platform. That triggered a digital bank run. A sudden, massive surge of withdrawal requests slammed into a system built entirely on paper confidence. And in a market of instant transfers, collapse takes very little time. The executives continued issuing polished, reassuring statements, but the users staring at frozen dashboards and missing money knew the truth. A bank run represents the ultimate moment of truth. It forces a company to mathematically prove the marketing claims it has been selling to the world. The implosion played out in mere days. Massive multi-billion-dollar valuations evaporated, and what began as a crisis of public confidence rapidly mutated into a full-scale legal emergency. The founder's public image inverted almost overnight. The tech visionary was gone, replaced by a glaring symbol of opacity, hubris, and financial ruin. A normal startup fails because its product lacks market fit, or its costs are too high. This system failed because the people running it were not honest about how the machinery actually operated. A bad business is disappointing to its investors. A deceptive one is corrosive, destroying the foundational trust of millions of everyday users. Modern financial markets frequently reward narrative and reputation over rigorous inspection. FTX is a case study in how those priorities can hide massive structural decay. The physical laws of finance remain unforgiving. Glossy branding, celebrity associations, and cultural momentum cannot satisfy a customer asking for their cash. The sophisticated empire was ultimately undone by a failure to answer a basic question of solvency. When the pressure arrived, the company could not prove where the money was or who actually owned it. If trust is the only mechanism holding a system together, the system is already broken. Belief can never replace actual capital.